You've heard me talk a lot over the last 6 months about the fact that I think 2023 is going to be a rough year. Whether or not it's a recession or not, we will see in the future. But there is no question that I think the next year will be very, very different than what we've experienced. I've seen kind of 2 or 3 recessions up close and personal. This may be your first, maybe your second. But in reality, I think this recession is going to be very, very different. And I think we need to talk about it because if you're not prepared, if you're not ready, you could get got. In order to have this discussion, we are bringing on the one and only Anna, REI mom, Kelly, for our Wednesday conversations. How you doing, Anna?
I'm great. Great. Happy last week of 2022.
Yeah, you know what, Anna, I'm going to put you on timeout. This is the last time we're going to talk. We're not going to talk till next year. You need to go on timeout.
Okay, I'll be a good little girl till then.
Well, you and I have seen a lot in our
Yes.
20 to 30 year investing career. I have come to think that what we're about to experience in 2023, and it may linger into 2024, is going to be very different than what my recent memory of recession. So I wanted to talk to you when you think about what is coming, perhaps what we're in. Do you think it'll be just like all the others we've been through? Or do you think this one might be different? And if different, in what kind of ways?
I definitely think it's going to be different. You know, there's a famous saying in almost like hopium that says, "Hey, but this time it's different, right?" But this time it's different in a negative way, potentially, right? So every recession has its unique characteristics, unique causes, and recessions vary very much in how deep they are, how long they last, and how diffuse they are. And by diffusion, I mean across various different sectors of the economy. So sometimes we have manufacturing recessions like we did in 2019, where everything else seemed to be okay at the time. .com in 2001 was mostly tech. 2008, 2009 was mostly financial sector, real estate, but it became very diffuse. And so I tend to think that this one has different causes, different potential indicators or factors that could make it deeper or longer or more diffuse than other people are predicting. But I think it's definitely going to be very different than what we saw in the last Great Recession of 2008 and 2009.
Yeah, and when I think back to folks watching this, right? If you're under, I don't know, 35, your only experience with a recession was the anomaly that was the pandemic, right? There was a recession called, this is the first recession I remember that was 3 months long, right? Most people talk about recessions being 2 quarters of negative GDP. No, folks, they called a recession for 3 months. And that was the ultimate V-shaped recovery. It was, fixed by $8 trillion or whatnot. But if that's your only experience, my fear is folks will think the next recession will be like the last, where we will go down, right? All of these tech stocks getting whacked, and they're going to hit some bottom, and then they're going to magically explode to the moon, right? The classic buy the dip scenario. And I don't think there's any chance that there's a V-shaped recovery. So that's the first thing I come to, is I want people to realize if that's what you're hoping for, I certainly don't see it.
I agree. And I think 2 things to come out of that. One is that after 2008 and 2009, because of how unprecedented and how deep and wide and global the recession was, there was a tremendous amount of economic stimulus put into the system in order to stimulate the recovery. And that recovery took a decade, even with interest rates essentially almost at zero and a lot of money pumped into the system. Now we have significant inflation, and we have certain factors, as we've talked about multiple times, of inflation that may be sticky. They may last a little longer. So the Fed simply cannot just, we hit a recession, let's start stimulating out of it right away, because we have too much risk of inflation rearing its ugly head again. So I think that's a really important difference from last time. The second thing is that most predictions by all central banks, I think all of them at this point, are saying over the next decade, we anticipate extremely low growth. Why? 1, because inflation is high. 2, because they cannot stimulate their way out of it without significant risk at this point, and taking interest rates much, much higher if there's inflation, and they just can't go as low. So in my opinion, this is going to be a very slow recovery period after we do have recession. much slower than maybe some prior recessions.
Yeah, the other thing when I look at this recession is I don't know. I mean, I wish I didn't feel this way. This is just going to be longer. I think to your point, there's going to be a series of dominoes that fall at different increments, but they will all fall nonetheless. And it's going to be longer. I think the average recession, depending on what data you look at, is either 10 or 11 months. It would not shock me if this is 6 quarters or 18 months. So I think the duration ultimately will be longer. How do you feel about that one?
I agree with you as well there. Recessions, again, it depends on the indicators you're looking at, but generally 12 to 18 months is pretty standard. But they're all very, very different. And so you have to look at how diffuse is this. So going back to kind of diffusion, I think similarly to 2008 and 2009, this is a global issue. This is not one sector of the economy. It's not just real estate, guys. It's not just the tech sector. This is very diffuse across the entire globe, in part because of COVID supply chain issues, in part because of war between Russia and Ukraine, and food shortages, energy crisis, deglobalization. Things were going very global. Now they're deglobalizing. And so you're going to have a lot of different things come back to different nations in terms of production. That's going to have a cost associated with it. It's going to take a lot of time to redistribute some of these trade lines. So I think globally we have issues of inflation, shortages, very low or slow growth. And those things are going to make this a much longer recession, in my view. I wouldn't be surprised if we have very slow growth well beyond 18 months. We may technically be out of a recession, but I think that this is going to be something that's going to take quite some time to stabilize, in my opinion.
I agree with that. The other point I was going to bring up, you just did this deglobalization. I think one of the things that will be structurally good for America in the long term is we bring more manufacturing home. We don't depend on people that don't like us as much in the future, which I think is net positive. Unfortunately, in the short term, that will mean more inflation as we build out more manufacturing, as we compete for resources to, move into manufacturing. Again, I think long term, it's the right thing. I think we'll be better off for it the next 50 years. But in the short term, we're going to feel it, and inflation will be stickier, right? I think the last part of inflation, which is wages and services, that's going to be sticky for longer. And going from what I'm thinking is 4.5 or 4 to 2, it's not going to happen quickly, I don't think.
Yeah, I agree with you again. We're on the same page for most of this today. I think that one of the challenges of using terms like, are we in a recession? How fast do we get out of it? Is that these traditional definitions of recession, of inflation, of stagflation, we're kind of in an environment where none of the traditional categories really describe what we're going through. I think we're going into more, and we're already there, in a period more akin to stagflation, which is when we have slowing growth, which is usually called recession, at the same time that we have inflation. And so we have areas of the economy that are going to have these elevated costs, like you just discussed. So we have inflation, but if we have slow growth or no growth at the same time that you have increased costs, you're really in a stagflation environment. The thing that's keeping us from calling it stagflation is that right now wages are still high and employment is still high. But once wages start to come down and we start to increase unemployment and there's a lot more layoffs, I think we're really more in a stagflationary environment for quite some time. And this deglobalization is going to keep that going, because as things have to redistribute, there's money that has to go into, building new facilities, chip manufacturing plants, things of that nature, developing new energy hubs and technology, and all the R&D costs a lot of money. And then they have to redo all the supply chains, the ports, the ships, what happens to all of that stuff. So I think it takes quite a bit of time. And I'm afraid that we're going to have slow growth at the same time that we have elevated inflation. So more of a stagflationary environment. And the reality is, Michael, if you look back at history, it's much harder for central banks to get out of that than it is for them to just get us out of either inflation or recession alone.
No, I agree. So we're going to close on a positive note. What I would tell investors, such as you and I and others that follow us, is don't rush, right? If you followed what we've been talking about and you stack cash, you have dry powder, do the work, look for deals. I'm very adamant. We are only doing great deals the next 2 years.
Yes.
Good left the building. You want that margin of safety. You want fixed rate debt. Don't do any of these short-term bridge debt arms. That's not the time. But yeah, I think there's going to be plenty of opportunity. Where there's great pain, there's great opportunity.
Always.
Yeah. So again, close with what you would tell some folks about how to take advantage of what's coming.
Yeah, I think being a patient investor and having a long-term lens on your investing is really critical right now. The days of we're in massive expansion, values only go up, rents only go up, et cetera, those days are coming to a slow halt, at least for a while. And so you cannot be investing on hope that in a year or two or three, something's going to be significantly better than it is today. You should be buying assets, in my opinion, that you plan to hold for a longer period of time, 5 years, 7 years, et cetera, or longer, right? These legacy assets you hold even longer. But if you can buy a great deal today that produces enough cash flow to cover all of your debt service, all your expenses, and a nice cushion, those are the deals that you should be doing. And then you just hold them. The great thing about providing housing is a human need. Housing, energy, and food. Those are the three main needs. Somewhat, less is transportation. But we invest in housing, and housing is something that people need in good times and in bad. And it's proven to be both recession resilient and inflation resilient. As long as you're holding it for the long term, you don't care what the value does in the medium term because you don't have to refinance the debt and you can continue to hold those assets that people are going to continue to need. So buy them, be patient, only do great deals that actually cash flow for you. Unless you've got some money that you can just, park in things that are going to preserve your wealth, which is number one, grow your wealth where you don't need that cash flow for a while, and plan to hold those deals longer as well.
And Anna, where can people find you?
You can find me on my website at reimom.com. You can find me on social media at Anna Kelly REI Mom.
Thank you so much.